So I'm going to be talking a little bit about big tech in finance, which is an absolutely enormous subject. It's probably warrants its own conference. So I'm going to try and just gloss over some bits and focus in on others in the interest of time and trying to keep the conversation interesting. And I'd welcome questions at the end. So if you think of something as we go through that you want to ask, please sort of save it to the end, and we'll hopefully have a lively debate. So a little bit. Does this work? Ah, perfect. A little bit about me and hopefully my credentials or lack of in terms of speaking about big tech. So I'm a software engineer by trade. I started out my career in Silicon Valley. I worked primarily in cloud computing for a number of years, so working on the early deployment systems for the likes of Google, Microsoft, and Amazon when the sort of cloud infrastructure and cloud platforms were in their infancy and growing quite rapidly. I then started a fintech business in early 2016, which is who I'm representing today. We provide credit risk products for major banks, fintechs, lenders, and a whole slew of other financial services organizations that allow them to make better credit decisions. But I'll stop pitching from there and carry on with the talk. So what is big tech? So a recent survey of 18 to 35-year-olds conducted by MuleSoft, in fact, said that about 52% of those people, so the millennial bracket, would consider using banking products from one of the GAFA companies. So these guys, Google, Amazon, Facebook, and Apple. In addition to that, a Bain study also said that about 65% of the US prime customer base would also consider using a banking product were they to get discounts or rebates from Amazon in return. So there's this constant threat that I don't have to explain to you guys of these big guys coming in and sort of eating the lunches of the banks and even the fintechs as well. So where I wanted to start with this was actually thinking about how these companies make their money today, which on the whole is through advertising, so through consumer data and through monetization of that data. So Google, pretty much all their money comes from advertising. Amazon obviously sell things, but they also have their growing web services business, so that's around 13% of their global revenue now. Facebook, advertising and some payments, and then Apple obviously make things and sell services. So if we correlate that to sort of what's already going on today and what a bank is in sort of most simple terms, we can kind of look at sort of four sort of quadrants. So payments, lending, current accounts, and insurance. And I agree this is sort of quite a simplification of what a bank is. There are a bunch of other different things that go on in high street banking today. But looking at those four things, we can kind of see that Google's already doing a bit. So they have Google Wallet, they have Google Payments, ways to make transactions, obviously key to their business and key to enabling some of their marketplaces, so the Play Store and other sort of services they offer through their Android ecosystem. They also have a partnership through Lending Club for so anyone using Google for Work, so the Google Apps Suite, can get access to SME financing through Lending Club in the US. So they're starting to make some moves in lending. Nothing currently in providing sort of actual deposit-taking current account, and they do some sort of comparison work, or did. They've discontinued this in the UK, so they had their Google Compare product, which basically allowed you to sort of price comparison website. Interestingly, that was actually stopped due to the regulator basically coming in and saying that they were putting their search results above, the money supermarkets and Go Compares of the world. So they are providing some level of comparison, and most notably in insurance, but still no actual insurance products. Amazon similarly has a payment ecosystem, as common to pretty much all these organizations. They do a lot of lending, so they do lending to their SME marketplace sellers, so providing financing against the data they collect through sales information. So they have a really interesting visibility of what a seller is effectively earning, and therefore can lend against that. Come back to that. They also have a sort of combined partnership with JP Morgan and Berkshire Hathaway on providing sort of health insurance cover, particularly for the US, where there's arguably a lack of that for their employees. And then we look at Facebook, again, payments. They have a partnership with Clearbank, so a product called Charged, a program that allows financing for advertising, so basically advancing the cost of advertising for early stage businesses, because they know that there's a lag in sort of return for those types of businesses. Again, utilizing the data advantage that they have, which is a common theme across the board. No current account, no insurance. And then finally, Apple. Obviously, we all know Apple Pay. Interesting, they've kind of used their scale and their sort of strength to effectively dictate the rules of how that payment mechanism works. So it's always been known for its smooth user experience, but I mean, I think it's sort of underneath that was the ability for Apple to use their clout to actually say, well, this is how we want this to work, and you, Mr. Bank, has to get in line with that. They obviously made the most recent move with the Goldman Sachs Marcus Apple credit card in the US. Forbes recently reported that around 5 million millennials intend to apply for that product. So really interesting one there, because they're embedding the credit card experience sort of horizontally across their marketplace, their ecosystem, to do payments, which gives them this insane advantage. You could argue akin to the days of Microsoft putting Internet Explorer on all their devices. They've sort of got this ability to have a better user experience than their competitors. So that's really interesting. And then in insurance, the Apple Care device protection plan, although not technically an insurance product, is starting to move that way, especially now you can buy iPhones on a subscription model. So you can, actually backed by Barclays in the UK, you can sort of pay a monthly fee for your iPhone and just trade it in at the end of the cycle and get a new one, and they bundle all of the insurance and everything with it. So controversially, I was about to talk about Libra and why that's interesting, but I'm going to kind of skim over this because someone's already done the job for me. But I'll, as I don't have a panel to tell me I'm wrong, I'll just sort of give my views really quickly on what moves Facebook are making with the currency, and how that potentially gives them this global money that was talked about in the panel that's just finished. So I think this has kind of been said, but it's a permissioned currency, which means that it's not a true sort of cryptocurrency in the sense that the ability to mine is restricted to a select number of organizations that are participating in the organization that's sort of establishing the currency. There's an interesting quote from Matt Levine from Bloomberg that sort of talked about this democratization and how it affects big tech versus incumbent banks and the like. So he said that the democratizing effect of the internet's openness and decentralization is counteracted by the vast economies of scale and network effects, which tend to concentrate power in a few big winners, which is quite interesting because we're sort of saying that internet and cryptocurrency provides this decentralized marketplace where everyone's equal and all that good stuff, but on the same time, on the same token, we're also saying that the same token, that's probably not a good use of term. In the same breath, we're saying that, well, actually, you get to the scale of a big tech company, then you have all these inherent advantages that mean that you have this greater clout, and you can dictate the way the currencies are structured, or the way payments work, or the user experience, or you can get closer to the user. So I think Libra is an interesting example of this, whereby they've attempted to kind of remove themselves from the establishment of the currency, while simultaneously potentially reaping all the benefits. And I think of, if you look at some of the organizations that are involved in establishing the currency, you've got people like Spotify and Uber and these heavily payments-based businesses that could potentially act as the carrot for people to adopt that currency rather than Facebook doing it themselves, and therefore them reaping the benefit. Although interestingly, they've claimed at least that they won't get any of the payments data themselves, so they won't be able to use it to boost their advertising revenues, for example. But we'll see how that pans out. So going back to my previous slide, I kind of hinted that there was this quite big gap in terms of actually taking deposits and providing current accounts. And obviously that's where the bite of regulation tends to hit for all these organizations. And so what I wanted to look at is why a big tech company might or might not choose to take that leap, and what the benefits are, and how they could perhaps circumvent the cost of regulation, the sort of extra attention it garners, while still getting the benefit for their business. So I talked earlier about Amazon's lending business. So this is where they lend to marketplace sellers to allow them to, build more stock, advance costs against their predicted revenue from sales in the Amazon marketplace. And again, this is an example of them using their data advantage to make smarter lending decisions. But interestingly, the growth of that business is rather stalled in the last couple of years. So I think in sort of 2018, it was something around 2.6%. I don't have the number written down on the slide, but one of the reasons they've sort of claimed that this growth has been stalling is because of the lack of sort of the full 360-degree view of the company, which arguably is something that a bank would have. So this could perhaps be one such argument where Amazon says, this is an advantage that we could really benefit from, and in our key geographies, we could be a bank to our sellers, and we could therefore provide them this whole suite of services that allows us to boost revenues in our marketplace and allows them to grow their business. And that kind of brings us back to that continual question that all these companies are trying to solve, which is, especially the ones that most of their revenue comes from most of their revenue comes from advertising, is how do we get more data and therefore get more context and therefore be more relevant to our customers? And I think that's the continual message, and banking is perhaps just one way that they achieve that, but it isn't really the end goal. I think no big tech organization is getting excited about being a bank. They're getting excited about serving their customers and being, so that's incredibly cheesy sounding, but being more central to their sort of financial world and their sort of general day-to-day transactions, whether that be payments or whether that just be using their services. So that kind of leads us to an obvious point, which is, do you actually need to be a bank to get that visibility at all? And certainly in Europe, perhaps not. So since the sort of advent of Payment Services Directive 2 and the resulting sort of open banking, lowercase o, lowercase b, growth across Europe, there's this argument that says, well, actually, do I need to be a bank? Do I need to go through all of that regulation just to get that information and be more bespoke and be more give that context to my customers? I recently, in fact, on this stage, saw a talk from Diana Layfield, the aptly named VP of Next Billion Users for Google, who talked about their process of building situational lending. So the idea that if they have this true continual view of a customer through their data, through their day-to-day banking, that they can understand the financial need and the context of a lending decision, perhaps before that customers even realize that they need credit, and they can implement credit policy around that gives them the ability to be most competitive compared to any other sort of marketplace lender or anyone else that's going to try and bid for that individual's business or that company's business. And it's quite interesting because there's this element of trust in this process that sort of wraps around it. And we talked about this, it was talked about in the previous panel, there's this weird disparity of trust when it comes to consumers. People trust their doctor who keeps their medical records in a filing cabinet, but don't trust Facebook that keep them encrypted and have a far more sort of broad-ranging information security policy. So the question is, again, why would I share my data with a big tech company to get these outcomes, and what experiences might they give me? So a couple of examples. So this is the Apple credit card. Interesting that at the moment they're kind of building some basic sort of interactive features around how people spend. But you could argue one of the ways that they might greatly improve this experience in this context is by using banking APIs to aggregate all of the data that an individual has. So if I could load in my, say, my Monzo account into this view of my spending and get rewards in return for that. Another one that's talked about a lot is payments. So this is an example of Amazon using a PIS open banking based payment method on a checkout. So instead of them using a sort of payment gateway and traditional payment rails, the consumer can give that merchant authority to access their bank directly. So in this case, a Lloyd's bank account, and transact it effectively at zero cost. It's a great incentive for them. Again, why would the user want to use it? What's the incentive for the user? And then finally, this contextual lending example that we sort of mentioned before in the sort of Google example. If I can sort of understand through the data and the consent process from my individual user over time what they're going to need before they need it, then it's a huge advertising and marketing opportunity, which comes back to the sort of current businesses of some of these big tech companies. So this is, I think, gold for them. You know, how can I anticipate that need using more data, and then how can I monetize that information, whether it be me as a bank or as a broker or whatever mechanism I choose making those lending decisions, or whether I work with a partner or cooperation to achieve that. And so cooperation is the key. And I'm going to skim through this fairly quickly because I'm conscious of time. But I'm not going to go through all of these, but this is an example from CB Insights of traditional banking and basically fintechs kind of eating the lunches of a traditional bank, and where they're working together and where they're kind of hoping to disrupt. And taking this to the UK, there are already great examples of big banks partnering with fintechs or partnering and acquiring fintechs to achieve these better user experiences. So the idea being that it's better to own the customer relationship and perhaps lose some of the revenue than completely lose the customer. So Santander doing a lot in SME with Cabbage, Albert, Asto, RBS similarly with Metal and Esme, and then Bo, their consumer bank that they've kind of incubated with inside the business. Barclays, obviously I mentioned earlier, through their partner finance wing, providing payments for Apple, and similarly using Flux for receipt data, so they're getting SKU level data for certain merchants, and then Bink rewards network. And then HSBC sort of choosing to go more down the back office route, so looking at certain AI software providers to provide smarter decisions for the data they already hold, which is really interesting. So the common thread here, well, there are a couple. So the challenges for these companies are really the big three. So for me, that's trust. So why would someone share data with company X, and what return benefit do they get? That's always going to be the value exchange. You know, whether you're Amazon or whether you're Barclays, it makes no difference. There's a question there whether the brand of one or the other is more trusted by consumers today, but I think either one holds a shot at that. Similarly, regulation. So can I actually walk like a bank, talk like a bank without being a bank? And I think that's a really key question to ask. You know, does PSD2, certainly in Europe, enable me to do all those things without incurring the extra scrutiny? And arguably, you know, these big tech companies already have enough scrutiny from regulators as it is. And then finally, speed to market. So will they choose to partner or will they build it themselves? And I think you can already see from some of those examples that partnership is certainly the route of choice for some of the big banks in the UK, and I think also some of the big tech firms will do the same. So those are the big three challenges. I think I'm just about out of time. I'll leave you just with some predictions. I'm not going to stick my neck out because I think I've kind of stated the sort of obvious in terms of the overall landscape, but I think this idea of a sort of a horizontally integrated banking experience will be the key. So rather than me becoming a bank and me providing banking services, it will be how do I integrate banking services across the board into all the different product offerings I already provide. And in that case, big tech is already doing a lot to do that. And I think that's where the question of whether they can earn trust to do more with things like consented data will become key. So that's it.
We got time for
We've got questions?
There's one on Slido, and we can take a few questions from the audience.
So do I think GAFA are bad for society? I mean, I think that what's bad for society is people don't realize with a lot of these organizations how they're paying for them. So we think of email as being free. We think of banking as being free. And both are incorrect, right? You know, we pay for Gmail with our data, and we pay for banking with fees and with other products being sort of sold around that loss leader. So this idea that something's free is probably what's dangerous, not necessarily the companies themselves. I think that if people understand the value exchange, then we're in a good place. But I can definitely see that they don't. I mean, the one that always gets quoted to me is like, how many people read iTunes terms of service before they sign up? You know, no one, right? So like people don't think about what they're giving over. They just tick OK and continue. So there's definitely more that could be done to actually make that data sharing process explicit, which is a big part of what we do as a company. But.
Hey, Shaheen. I work at Xero, the cloud accounting software. So I agreed with most of what you said, actually. I completely agree with a lot of the kind of assumptions you've made of what you see coming and how big tech are going to impact the banking industry. I wanted to know kind of what your take is on the marketplace or platform strategy that a lot of the challenger banks are taking up and a lot of the incumbents are starting to mirror.
Yep.
The platform and marketplace strategy is obviously really strong in building those network effects, and I think what that does is actually nails those three challenges that you talked about, because the customers feel like actually the bank cares about the services I need that are outside of just the bank itself. So how do you think the marketplace and platform strategy is going to differentiate challenger banks versus incumbents, and how do you see that playing out?
Yeah, I think it's a really interesting question. I mean, the classic example of a marketplace is probably Amazon, right, where they did this clever thing of allowing a free open marketplace and then taking a look at which marketplace sellers did well and basically replacing their products with Amazon Basics versions and pushing them out of the market. So there is like both sides of the equation when it comes to marketplace, and someone's always controlling a marketplace, right? For banking, I think there's something similar that could happen, because at the moment there are pockets of customers that banks don't serve particularly well, that they're kind of openly aware of, and that they're willing to kind of say, well, actually, you know, SME lending might be a really good example of this. You know, some of the systems are already in place that allow customers that don't get serviced by a high street bank to go through a kind of a marketplace like funding exchange or funding options to get to a lender is really interesting. But I think the big question comes when they start to fish for the same customers, right? So if I'm you know, a big bank and I've built this suite of marketplace tools, what's to stop the marketplace including a loan that's at a better interest rate than my own loan, and then what happens in that dynamic? You know, do I sort of control the marketplace so that doesn't happen, or is that good for me? And I think what seems to be happening, you know, I probably naively thought when people start talking about banking marketplaces, why the hell would banks give a really easy way for people to leave them? But what they actually want to do is retain the relationship, and they don't mind losing some of the revenue if they can better serve their customers through partners. So I think that's a really exciting model. And, you know, Starling is obviously going down this route when you talk about challengers, Tandem to some extent with their aggregation product, and then they're selling credit over the top. Whereas, you know, others have sort of gone for a more embedded process. So like Monzo, for example, are trying out energy switching, mortgage applications, but through select partners to keep the user experience really consistent.
We'll just take one more question over here and then it's time.
Sure.
Hi, Freddy. You were talking about partnership between big tech and big banks, and the couple of examples you gave were Goldman Sachs partnering with Apple and muted discussions between Amazon and JP Morgan. Both, from my perspective, seem as much a ploy from couple of big US investment banks to reach a bigger mass market. So do you think for the time being it seems big banks need big tech as much as big tech needs big banks?
I certainly agree in terms of distribution. You know, that's obviously the goal of all these companies, and the big techs have, you know, arguably the biggest stronghold in terms of user base. I don't think that it's just a case of, well, in some cases I think that, you know, big techs are just sort of making experiments and testing things out. But I do also think that they've realised that, you know, the regulatory hurdles they're required to go through to be sort of multi-geography with some of these offerings are very high, and it is better to partner and sort of capitalise on what already exists in sort of each geography to create a best product. And especially now everything being so API driven, it's possible to do that quite seamlessly. I think the banks themselves may also try and build more product around. In fact, it's not a case of I think. I mean, they obviously are building more to kind of engage with users and attempting to do that. But as far as I can see, that's much less proven than the sort of the movement from the, you know, this is the argument, right? Is it easier for Amazon to become a bank or Barclays to become a marketplace and a seller? And, you know, you can easily say that it's easier for Amazon to become a bank, not that it isn't hard. So I think that perhaps the banks have more to lose in that trade-off, and probably would do anything to kind of get on board with someone with such a user base as Amazon.
Thank you, Freddy. So big hand for Freddy.